If everyone could slowly walk towards their seats, that would be great this morning. We're going to get started in about 2 minutes. Thanks for taking your seats, everybody. Thanks for taking your seats, everyone. Am I gonna have to call you out by name? I mean, come on. Chuck. Especially you, Jason. Take your seats. Thanks for taking your seats, everyone. I'm gonna have to call people out by name or something. Great. Good morning, everyone. Thanks for taking your seats, and it's good to see everybody this morning. Another hot, humid summer day here in San Diego. Great to have so many people here in person, and great to have people joining us via the web too. My name is David Jacobs. I'm not Bill Super. Bill, unfortunately, we're going to be missing him this morning. Had a small procedure yesterday. Recovery's just lasting a little longer than expected. So Bill, we know you're watching, and we're thinking about you. I'm sure you're doing great, and we'll see you soon and recover quickly. Glad you're all here. We have a great presentation this morning and excited to get started. Today's presentation is called Bringing Insurance to Life, Actual Client Case Studies. And George Alexander, our longtime North County Estate Planning Council member and board member, will be here speaking. You were on the board, weren't you, at one point? Maybe not. All right. Anyway, we're gonna pump up your resume all morning here. Thanks for being here and appreciate everybody's attention this morning. Couple of quick announcements before we get started. First of all, really want to encourage everybody to attend these in person. It really is great to have everybody here. It's wonderful if you can't join us in person to be able to join us via Zoom, but it's really great to have everybody back here in person, the collegiality. Great to have everybody back and shake hands and see everybody in person. Really, it really makes you happy that the pandemic is over and everybody can get together again. Except this summer, it might come back, right? A couple of very quick announcements. The next meeting at the council, which is going to be in September, first Tuesday of every month, of course, is going to feature Phil Lindsay. He is a national expert in elder law matters, and he's with San Diego Elder Law. He's going to be talking about a couple of different issues that are facing seniors, including Medi-Cal benefits, conservatorships, probate, trust and estate plans, special needs, and trust administration. So we hope you will join us next month for that meeting. October 3rd, we have Dana Telford of the Family Business Consulting Group presenting on family business succession and transition planning. In November, we have RJ Kelly, who I think is here. Did I see RJ this morning? I didn't. RJ, you're probably joining us via the web, but good morning, RJ. RJ is going to be, RJ and a panelist are going to be presenting on charitable and income tax planning when you hit a home run, the sale of real estate, sale of businesses' assets, or sale of businesses' stock. And in December, we are going to welcome Robert Valera of Voight Real Estate and Bill Exeter of Exeter 1031 Exchange. They're absolute experts in dealing with like-kind exchanges of real estate and have been, Bill wants me to note that they were been there since the beginning when the Starker case came down and 1031 exchanges were first developed. So that's going to be a great presentation. That's in December. Let's see. Great. What I'd like to do now is introduce our nonprofit spotlight this morning. We are lucky to have Allie Hanlon of the Boys and Girls Club of San Dieguito. Wonderful organization here in San Diego. And I want to bring up Corey Grant because Corey has been involved with the Boys and Girls Club here in San Diego for a long, long time. And I'd love him to introduce Allie and talk a little bit more about what the Boys and Girls Club does before Allie makes her presentation. Corey and Allie, welcome.
Thanks, David. I don't know if it was just me, but you know, I'm so used to seeing Bill on the screen with his big hair. And so, you know, seeing Dave here with a clean cut and trim it's really kind of a contrast. Maybe we can get one of those wigs and like, or maybe Bill can shave his head. That'd be even smoother. You know, all kidding aside, Boys and Girls Club of San Dieguito. What is San Dieguito? It's this greater area, Del Mar, kind of north to Carlsbad and east. We serve a number of kids in this community. People think, hey, you're in a wealthy zip code. There's not kids that need help. That couldn't be further from the truth. There's a lot of kids here, little pockets that really need the club as an after school activity. I've been on the foundation board for 20 years and they just do a ton of good work. And Allie is I've been here since forever, since you're a little kid, came up through the club. So now she's the donor development director. Did I say that right? Donor relation. Anyway, she's one of the backbone of our executive team there. And so Allie, thanks again for coming tonight or today, and look forward to hearing.
Thank you, Corey. Hi, guys. We had a video, so this can be a little shorter. I don't know what happened with the video, but we're gonna go with it. We service, like Corey said, Carmel Valley through Encinitas. We're in the process of merging with Boys and Girls Clubs of Oceanside to try and serve more kids. Our missions are very much aligned, and we feel like it's a great opportunity to serve more kids in the community. But today, we serve 4,615 registered members at all of our locations combined. We have 7 clubhouses, 2 in Carmel Valley, 1 in Del Mar, 2 in Solana Beach, and 2 in Encinitas, and 7 specialty programs, including our Big 8 middle school sports, which in 2003, when the school districts decided they didn't have any money left to pay for middle school sports, Boys and Girls Club of San Dieguito stepped in and took over their middle school sports program. So we run all of the middle school sports for San Dieguito Union High School District. Our thought process was we wanted to make it affordable for the kids to be able to play. A lot of kids can't play the club sports that are in the area, and we wanted to give them the opportunity to do something during junior high so that they could participate when they got to high school. We also do Bulldogs basketball. We have a Montessori program running in Carmel Valley. Our Rancho San Dieguito swimming here in Solana Beach. I talked to a few people who swim at our pools for our master's program. We do adventure camps in the summer. We have our Youth Arts Academy. Again, in 2007, when the school district didn't have money to keep musics in the schools, we took over. So we have our Youth Arts Academy, which does private group rock band, and we're starting a theater program. So we are keeping the arts alive for the kids in the area. We give out over $3,850 in financial aid. Oh, he does have the video. No worries. And we give out financial aid. So we don't turn away any child from the neighborhood that needs to come. I was one of those kids, as Corey said. I started at the club at 8. My mom got a divorce. She was a single mom, moved us up to Encinitas, had nowhere for us to go, got turned down because she made a little too much money to go to another organization. And we found the Boys and Girls Club, and I never left. I've been here for 25 years this summer working. Don't do the math. That makes me really old. But that's the great thing about our organization. We have a really big tenure of staff members who have found a love for what we do, and we've stuck around. We have over 20 staff members that have been there 15 plus years. And that's a testament to, I think, the kids and the staff and what we do for the community, because people just don't want to leave. Somebody knew Chrisanne, who's been there 35 years. She was my counselor as a kid, and she runs our Encinitas Club. Video's still not ready. Oh, I'm going to let the video go, and then I will continue because this gives a lot about what we do.
We serve over 10,000 kids a year. They walk through these doors with a lot of time on their hands, and we take that time and make sure that they're doing something valuable with it.
Boys and Girls Clubs, they give them hope, opportunity, because they have an opportunity to become anything they want to be.
Some of these kids come from families that have nothing.
Being raised by a single mother, she worked hard to provide for us. If I didn't have a place like this, I could have went the other way. Kids that don't have places to go and are left alone at home usually get in trouble with the law.
We really think that by kids being here, we're able to keep them off the streets and we're able to keep them from getting into trouble between those very key hours of 3 to 6 p.m.
We started with one club at a budget of $25,000 a year. Now we have 7 clubs with a budget of over $5 million a year. But we're doing something right.
Well, it's the relationship that the staff has with the children. That's the key thing. And you just have to make sure you hire the right people. And we were blessed with that kind of a thing.
My job is to make sure that they are safe and they're loved and they're cared for every minute of the day that they come to the Boys and Girls Club.
This staff is amazing. I know all of them personally.
Everyone works here because they love being here.
A lot of these kids that come through the Boys and Girls Club that are Keystone members have been here since they were 5 years old, and they call me mom now. So I call this my home. So whenever they come in, this is my house. This is my life. This is your house. We are a family.
It is one big family. We call it a La Familia. The kids need something, they don't hesitate on coming to us, the parents as well.
My favorite thing about the staff and the teachers is they're so supportive. I love the spirit at the Boys and Girls Club.
I like that it teaches kids what work ethic is.
I've had a lot of problems at home. I've had things happen, but the staff care and they love me as who I am.
For families that have children with disabilities, that this has been a wonderful place for our family. The boys have really grown and their self-esteem has increased.
57% of our alumni say that the Boys and Girls Club saved their lives. That's good enough for me.
We have the best programs and we really thrive to push them to be better all the time, but there's a cost to it.
There's always going to be that need in any community, not just lower income, which we do have in this area.
We don't ever turn a child away, especially for financial reasons.
We have scholarship programs for those that can't, and for those that can, the dues are very, very low.
So your dollars go directly to helping kids have great futures.
There was a time where my mom was struggling to pay the $25 a week, morning camp fee, and they helped her out when she couldn't do it. And they said, "Don't worry about it, Barbara. It's okay. We've got it. Give us money when you have time." And for a kid like me that didn't have a lot, this place gave me everything.
Before Boys and Girls Club was able to open up their doors for the scholarship, I was turned away by several other organizations that are similar to this one. This place is for everyone. I mean, it took a look at the bigger picture and it took a look that every kid is deserving of this amazing place.
If you have any means of donating, this is a great organization to donate to. There's so many kids that need us for various reasons.
Only thing you have to do is go to any of the Boys and Girls Clubs in the San Dieguito area, walk through that door somewhere between 3 o'clock and 6 o'clock, and you're gonna see that that money's being really, really well spent.
If it wasn't for the Boys and Girls Club, I don't know where I'd be. I don't.
I will tell you, I was a shy child and I didn't think that, you know, it was possible to sing in front of people, but the staff members and at the club and even the kids, you know, everybody getting together and encouraging each other. It really helped me pursue my dreams.
It's a beautiful feeling to be surrounded by people who truly care about you and want you to succeed.
And I just want to say to all the people who have had some connection to the Boys and Girls Club that they're really, really, really making a difference in the lives of the kids. You may not realize it, and sometimes kids may not acknowledge it, may not say anything about it, but deep down, like there's a huge, huge change happening in their lives.
Sorry, that video was produced before the pandemic. In 2020, we had to shut our doors for the first time in 55 years. We're been open 57 now. And we were one of the first agencies for youth in our community to come back open. So we opened our doors in June of 2020 for first responders and families who needed us the most. We became, you heard home or the home away from home, we became the school away from school. I was super impressed with our staff. We mobilized. We had kids in school in our facilities for over a year doing Zoom. I had a second grader at the time and I could only do it with one child and was in tears almost every single day. They were doing with 50 to 60 kids on different classes every single day at each one of our facilities to try and reopen. We still aren't at our fullest capacity just because people found other locations and needed things, but we are getting back up there. We have over 10,000 kids again in our programs and 975 about each day come after school to our after school programs. We pick up at the local high schools and junior highs and elementary schools and try and keep the kids and needed thing in the community. As Corey was saying, a lot of people think we don't need the help, but we have kids on 100% scholarship. We have 2 of our facilities that have over 95% of the kids on scholarship. So that's us in a nutshell. Anybody have any questions? Oh, there's one in the back. I have cards on me. Also, our contact information is on the sheet that either got handed out or is at the front. Our CEO, Marinica, or myself, or any one of our team would be happy to do tours or come to you guys or do coffee. Corey is an excellent asset for our organization also.
Yeah, Allie and Corey, that was great. Really appreciate everything you do for the community and what an awesome organization. Let's get moving through the agenda really quickly. You know, by the way, Corey did bring up a good point a second ago, and that is it is weird to have me up here and not Bill. And so I figured, Bill, this is for you, buddy. We really miss you. And we'll do this next round of announcements in your honor. I do want to remind everybody to visit the North County Estate Planning Council website. You can not only register for meetings, but please update your profile and especially your photos while you're there. We really appreciate that. Second announcement is Pete Tentler, who runs our amazing Trifecta program. This is where you get paired up after this meeting with another professional or two from this group to get to know each other in a more intimate setting, get to know each other's businesses and personalities a little bit more in depth. Pete, take it away.
Good morning. Good morning. Thank you. I'm gonna do this every time. There's a lot of new faces here. It's a good turnout. I think we have about 51 people in the room. There's a lot of new faces. What we do here at North County Estate Planning Council is the trifecta. That's where I'm going to pair you up with two other people. Hopefully these are going to be people that will complement your industry, and encourage you to get together for about an hour, whether it's coffee, breakfast, lunch, happy hour, maybe even a hike. So I'm going to pass this around and put your business card in there if you want to be part of the trifecta. Those who are members of the group, how many, just by a show of hands, how many have really benefited from the trifecta? Okay, so this is something that, again, this is where you can really highlight what you do and how you service other people and how you can be a resource for other people of the council. So thank you for taking that off. So I'm going to start it here and pass it around to Paul's group and then back around this way. So if you have any questions or any requests, just write it on the back of your business card and I'll do my best to pair you up with them. Thank you.
Yeah, that's a great point. Thanks, Pete. Thanks for doing such a good job with the trifectas. It's really a great, a great service of the council. Those meetings are just a great way to get to know people. We need to move things along a little bit. So I just want to, without further ado, bring up our speaker this morning, George Alexander of Showley, Archembault, and Alexander. He is one of the council's advanced life insurance professionals, and he's going to highlight opportunities and solutions that life insurance can provide to meet a client's needs. One of the things that I think George is going to talk a little bit about too is about opportunity spotting, which is really important, and go over a couple of really unique case studies that he's worked on personally over the last couple of years. You know, George is one of several different advanced estate planning professionals we have here at the council. Corey Grant, who you heard from this morning already, John Kramer here in front, Barry Edney, myself, I'm also in that field. So it's really nice to have George come and present some of these solutions to you this morning. There are some nuanced elements of policies that George is really an expert in, and that I'm really excited to hear him talk about this morning. So without further ado, please welcome George Alexander.
It's all right. Oh, wait a minute. Can I pick this up?
Yeah.
Here we go. Is that all right? Brendan, will I wreak havoc with you if I move in front like this? This okay? All right, great. And how about the microphone? All right, all right, great. All right, thanks for everyone for coming. I know it's August 1st and, you know, people are on vacation, but it's really great to see this tremendous turnout. So, and of course, great to see a lot of wonderful friends here and professionals in the room. Anyway, this discussion started probably about 4 or 5 years ago, and Bill Super, as you all know, is a very passionate person. And Bill said, you know what, we really need for the council and for all of our advisors, and he particularly is hard on his own profession, the CPAs. He said, we need a list of opportunity spotters. We need things. I want you to, and of course I gave him a few, and he said, dig deeper. You've got to make this deeper. We need things that, it's got to be meaty. We have to give highlights. We have to give points to people to get into this, so they will actually be motivated to talk to their clients about life insurance, or at least to get the clients to start talking. So the presentation is broken really into three areas. And the first is highlighting opportunity spotters. The second, I'll highlight a couple of actual claims. This stuff works. People do die. People have long-term care situations and claims are paid. And then I've got 10 case studies. I don't think we're going to get through 10 of the case studies, but hopefully we'll get through 6 or 7 of them. And each case study, there's a few that are a little bit redundant, but there are some unique aspects to each case study. And one of the things I was mentioning to Jeremy Pearl we were talking, having coffee, is that a solution that might be available today may not be available tomorrow. And things can come and go. And I see John Kramer nodding his head. Anybody who's been in the life insurance business for any period of time, right, David, knows that sometimes there's some anomalies and every now and then you get lucky. So anyway, let's go to the opening slide, Brendan. And so starting with businesses. So with the opportunity spotters, we're going to break it into businesses, term life insurance, permanent life insurance, private placement life insurance, premium finance, and life settlements. Could try to go through these quickly so we can get to the case studies. But in the businesses, you've got key person coverage. A lot of times it's the person, if it's a small business, it might just be the one business owner. It might be a couple of partners in the business. Buy, sell. I'm working on a case right now with 3 brothers. Excuse me. And, how do you cover if a person leaves during lifetime, if they happen to die, unfortunately, while they're still running the business, if they have a permanent disability, executive benefits. In our town, San Diego, you will frequently see that there might be 1 or 2 key people. And very often that executive benefit plan, for better or worse, is funded with a life insurance policy. Some of the life insurance policies aren't that good and kind of clunky. And so you look at the cash values and what the premiums paid. Some are quite good. In the large corporate marketplace, there's a lot of this where it deferred compensation plans, the golden handcuff. How do you get top talent to stay with you? And very often, if you really pull back the curtain, very often it's life insurance. It plays a role in this. It might be combined with stock options and so forth, but very often life insurance is part of a corporate benefit plan. And it also might allow the executive to defer money because the 401k plans have limitations. So, and there are some interesting products that the carriers have that are high cash value products. Maybe the expenses are lower, and life insurance has the benefit of tax deferred growth, tax-free withdrawals to basis, tax-free loans. Area, health issues. If we have enough people, sometimes we can get what's known as guaranteed issue, where if somebody is uninsurable for life insurance or long-term care, if we have enough people, we might be able to get them some level of benefit without having to have a physical exam. And so that's called guaranteed issue. And then a recurring theme of my talk is the last point, which is policy review. And we say it over and over and over again because very few people ever review policies. And why in the world would you want to review a policy? Because who wants to think about death? Who wants to talk to an insurance broker and think about these complex products? And who wants to call the insurance companies with their very often less than wonderful policyholder service? So it's a tricky area, but all the more reason why it needs to be dive into, because, and you'll see in a couple of these state case studies the results. Okay, Brandon, next slide, please. With the families, just the classic topics, replacing income of the breadwinner. How will long-term care be funded? Special needs children, mortgages, all those topics for the families, certainly with some means. And even if you don't have superior means, still the estate planning topics. I've seen in our own personal family how important it is to have I have very old, elderly parents, and how important it is the healthcare directives. Jason, you and I've talked about this before, that, you know, who is the one who's going to make that decision for you about, you know, going into a facility or not, or, you know, really serious end of life issues. So obviously that's a topic for the lawyers, but, you know, very important that we all take a look at that, and part of the whole review process. Again, the last point, you know, how often are the policies reviewed? Policy review. People don't do it often enough. Okay, next slide, please, Brenda. David asked me to talk about the types of policies. And so very quickly, these next two slides, David addressed that. Term insurance, very inexpensive for a period of time. It's a fabulous vehicle. It really can, you know, you can get a lot of coverage, particularly if you have people who are very healthy and younger. You can get lots of coverage and take care of a family with a big life term policy. I've got a case study in here that's actually a tragic death claim, but it can be very inexpensive. An important part of term life insurance is the conversion provision. What conversion mean? Conversion is allows the policy owner to take the policy from term and turn it into a policy that they can keep forever, for a lifetime, some form of permanent life insurance. And where this is most powerful is when you've got people with health issues. So the policy might have been issued at a super preferred health rate, the very best you could get, the very lowest premium, and now they have prostate cancer and they're completely uninsurable. We have a woman right now she was issued almost 10 years ago, a term policy at the very best rate. She has a liver condition. She's completely uninsurable. Her conversion period will end at the end of this year. And so we're already in discussions about what's the best option with that particular carrier to be able to convert so they can keep this coverage forever. A $2 million policy. She got issued at super preferred. Now she is completely uninsurable. So the current conversion program is very powerful. The carriers know that they get I'll use an insurance term, adverse selection. Steve, what does that mean? It means that we're getting risks we don't really want. And the carriers have clamped down, and now the newer policies have limits on, much more limitations on the term conversion, and they might even only offer a very expensive policy to convert to. Next slide, please, Brenda. All right, types of permanent insurance, David. Whole life, universal, index life, variable life. I won't dive into all the details here, but there are various forms of permanent life insurance. By that, I mean insurance you can keep forever, and policies that also build up cash value. It's important to know what's the state of the insurance company. What's the financial state of the insurance company? We've seen carriers pull out of the U.S. MetLife, who would have thought that MetLife is not selling life insurance in the United States? They don't do it anymore. It's now a company called Bright House. They find more profitable business overseas in Asia. They could charge more. So they're no longer in the U.S. marketplace. Genworth and Voya, what have they done? Well, they're basically out of the U.S. marketplace. Conversion, I see John Kramer shaking his head. What can you convert to? The policies are terrible, very expensive. They don't take care of their clients. So that's part of our job. David Jacobs and Corey, all the people in the room who are focused in this business, we not only look at what's the pricing, how do these policies illustrate, what do they offer, but who's the company behind it? And do you really want to have a long-term lifetime relationship with this company? Very important. In-force illustrations, those are the projections. What are we going to pay? What's the cash value? Very often, usually what we see, because interest rates have been so low, is that you need to pay more because the cash values weren't big enough, and the policy requires more funding to pay for the underlying cost of insurance. Owner and beneficiary designations. On more than one occasion, I see David shaking his head. I've seen clients, business owners with a former business partner who's still listed their business for 5 years. They're still listed as a beneficiary on a policy with a business. A couple that's been divorced for 10 years still has an ex-spouse named as a beneficiary on a life insurance policy. That's okay if the divorce decree called for it, but it's not okay if you're counting on that to help your family and current spouse. How's the health of the insured? More questions. And that's part of also our job, is to keep asking the questions. Are you paying too little, too much, usually too little? That goes back to those in-force illustrations we can get from the carriers. Sometimes they're hard to get, but that's why it requires a professional, somebody, not necessarily me, but somebody to do that, to work with these carriers to get the updated information. Next slide, please, Brandon. Okay, I'm just going to touch on this briefly. Private placement insurance. It's been talked about right here. Jenny Bratt and Helen Cheng talked about private placement insurance. Mark Morris talked about private placement insurance. And just very quickly, this is a product for the wealthy. It is a very low cost life insurance policy. And we're using life insurance as the umbrella because it's a very heavily tax favored vehicle. And you can effectively choose your own money manager. Now, that's gotten tougher over the years, and there are more restrictions on what the carriers will put in. John Kramer and I have some personal experience of dealing with this with a large financial institution, actually. But anyway, the idea is that really what this is an investment, and you're getting the absolute minimum amount of insurance, the absolute lowest possible cost. And now you've got this tax favored vehicle, and life insurance is the umbrella above it, and private placement insurance. And that there's also an annuity form. Okay, next slide, please. Premium finance, just like people finance buildings, Douglas Wilson, when people finance buildings, same idea. They can finance large life insurance policy. And the idea here is that really, and I know that some people in the industry talk about, well, the policy performance, and there's an arbitrage between what you borrow and cost, I'm often in jargon here, but where it really works is if you've got a business owner or maybe a real estate investor who is used to borrowing, and they might have a capital intensive business, and they're used to borrowing. They're comfortable with borrowing. They're comfortable with interest rates going up a little bit. They're used to that, and they have the financial, they've got the balance sheet to justify it. And these are premiums that are a minimum of $100,000 a year. Anyway, for the right family and for the right business owners, premium finance can work very well because they leave the capital in their business, and they pay a small amount, for the life insurance. Now, there is a day of reckoning. That loans has to be paid off at some point. And if you're on the younger side, you want to have some exit other than death to pay off the loan. Anyway, I won't talk too much about premium finance, but it is something to look at. And I'll come back to, actually, we have a case study where premium finance was very helpful. Next slide, please, Brandon. Life settlements, selling a policy. What is this? What's the jargon? Well, if somebody's got a policy that they no longer need or want, they don't want to pay the premiums, life settlement, there's a market, there's the institutional buyers that will buy your policy and keep it until you die, or they might actually package it up with another tranche of policies and resell them. Some of the biggest buyers of policies, it used to be AIG. I don't know if AIG is still the biggest buyer of policies. I've heard that a few of the other carriers, John Hancock, I think, is investing in a fund that buys policies. So I think Protective Life. So who buys them? Knowledgeable people. Why do they buy them? Well, they're looking at this as I think the carriers are looking as a way to offset what they're doing by issuing life insurance policies, but it's an opportunity for gain. How? Well, we know that the death claim is going to be paid. And where this really works, and I have a case study that I'll show you, is that if the person was in terrific health when the policy was issued, they got the super preferred rate class, and now they've had a change in health, and now they're uninsurable, or they've got some other, they would now be able to get insurance only at a very high rate. That's where the life settlements can work. I'll show you a story in a minute. Next slide, please. Quick reminders: clients get sick, uninsured, they become uninsurable, they die. Since COVID, it's gotten tougher to get policies. Next slide, please. And I've certainly seen, and not so much this year, but the prior 2 years, 21 and 2022, we had several people get declined for insurance lots of health issues, and we've also had lots of claims. And again, very, very few people, this is a recurring theme, ever review policies. Next slide, please. All right, I'm going to talk about, I have 5 claims in here. I'll talk about the first 2. And this one is a pretty dramatic story. So in 2021, a friend of mine who runs a property casualty insurance agency said, hey, I've got a friend who's a neighbor. Our kids are friends, and he's been working as a professional for another corporation, I think in the healthcare consulting arena. And he needs a policy. He's very busy. He's going to need somebody to kind of push him along with this, but he needs to get, just a term policy, and please stay with him, get it done. It's not going to be a big premium, but please help this fellow get a policy. Anyway, lo and behold, September 21st, 2021, we got a $2 million term policy on a 45-year-old male who was in very good health. He got a preferred rate class, not the super preferred, but he got the preferred rate class. The premium is $1,228 per year, $1,228 per year, $2 million of insurance. On July 15th of 2022, I get a voicemail message, and a woman calling saying, I think my husband, she didn't know for sure, has a life insurance policy with you. Please call me. I called her back. And the story, as you can see on the slide, is that he went in on July 9th for a knee surgery. I think he had a torn ACL. On July 10th of last year, massive stroke, dead, 45-year-old gentleman. So that afternoon, the 15th, when I got the call, it was a Friday, and a friend of mine, Norman Kane, who lives a mile from here, so has a South African orthopedic surgeon. He's got a tennis court in his backyard. So Norman and I and another friend, Brendan Galis, were hitting tennis balls. And so I was just stunned. They're both doctors. And I asked them, and Norman and Brendan, I said, what could have happened to this poor guy? And they both immediately said he probably had a blood clot and a stroke. Well, they were right. So Norman, and I'm not very good at South African accents, but a very bright guy, and he said, George, tell me about the policy. I said, well, Norman, he had $2 million of insurance. What was the premium? Under $1,300 a year. George, you didn't do your job. Norman, there's $2 million of insurance. At those prices, he should have had $4 million. That $2 million is going to have to take care of his family for a very long time. All right, let's hit some balls. So, you know what? Norman was right. And that made an impression on me. And so now when I'm talking to, and I've had a lot of death claims, but when I'm talking to some of these younger people who, particularly with, bright futures, young professionals, attorneys and doctors, what have you, I really hit this with these guys, and I tell them, look, you might have spent another $500 a year. That's a small mistake if you got $3 million, or maybe $1,000 a year. That's a small mistake, but your family might miss out on $1 million or $2 million if you happen to have one of these tragedies. And we have other stories like this. I could go on and on. I remember walking into one house where the lady had the bills stacked up, and her husband, who I think was 46, and he died, and she was terrified, had no idea how much insurance that he had. Anyway, okay, next one. Okay, life insurance claim number. This is the only other claim that I'll talk about with a little bit of detail, but this was an interesting case because it was a business case, a very successful business. It was one of those millionaire next doors. The husband had been in World War II and started a business, bright guy, probably worked 7 days a week. And his wife was also bright and very hardworking person and helped him a lot with the business. And when we first got involved, actually, they were both still alive. So what we do is and I have a slide on this at the very end, it's called medical underwriting and formal underwriting. Room know all about this, and these guys do it all the time. But we get medical records, we have physical exams, and then we go out and we shop with the carriers to see what kind of pricing can we get? So we started this process with both of them. We got medical records, and the man was getting decline. Well, a month later, he drops dead. So he had serious heart issues, and he died, and that kind of put everything on hold for a while. And then about 6 months later, the family got back to it. The trustee who was bringing me in, who's a CPA, and we got back to the business of medical underwriting. And there was competition. There was another agent from a company that sells primarily whole life insurance. Anyway, in the end, she qualified for super preferred rates. I had a guaranteed universal life, which means that the premiums were about 50% of the premiums of the whole life. So the trustee prevailed on the family, even though the other insurance agent was a longtime family friend. Our premiums were 50%. So they went ahead with this policy. Happened to be with Mass Mutual Guaranteed Universal Life. Anyway, 18 months after the policy is issued, the trustee calls me and he says, I just want to make sure that, when was that last premium paid? I said, well, what's going on? I just want to make sure policy's okay. What's going on? He calls me a week later and he says, Barbara has stage 4 pancreatic cancer. Less than 3 weeks later, Barbara was gone. Now, the policy, one of the reasons I want to tell you the story is that the policy was within the first 2 years, the contestability period, which means that the insurance company can research the claim. Did we get all the medical records? Was everything disclosed? Was there anything we missed? And it's a law, the contestability period. Well, like, most families, particularly wealthier families, what was happening? The kids were fighting. The kids hated each other. They were changing the locks on the door to mom's house. So even though this was owned by a trust, the insurance auditor wanted to, interview the kids, and they would never meet. Anyway, finally, 6 months later, the kids met with the insurance auditor, and the insurance company paid the claim. And $7.5 million, they also paid interest. But in any event, it's just another, claim that I lived through, and the people were fighting. Okay, next slide, please. This one, just very quickly, poor guy got ALS, Lou Gehrig's disease, 3 years after the policy was issued, paid the claim. Next slide, please. Here's an $11 million policy. Policy was 10 years old, and the woman and I were talking literally the week before her death. And as far as we knew, her health was terrific. She thought her health was terrific. And in fact, we were playing around with illustrations. Can we carry this to age 98? Can we carry it to age 105? All that sort of a stuff. Week later, her son calls me, very distraught. I have terrible news. My mother had a massive stroke and died. And of course, Sun Life was the carrier. They paid out the $11 million, and just a kind of dramatic case. Next one, please. I'll go through this. This guy sailed around the world, never made it. Boat was lost, and it took us 9 months to get a death certificate. And once we did, the insurance company paid the claim. Next slide, please. The last thing I'll say about life insurance claims is that every single claim we've had, the life insurance companies have paid. And we've had several where people have died during the contestability period. And the clients have been honest, and they've disclosed, their medical records to the best of their knowledge. And the insurance companies these days do a very thorough job of, underwriting. That is at the beginning, getting those medical records, getting the reports. They even do what they call now RX, pharmacy check. So if somebody applies for coverage, in addition to medical records that are reported, they might find other records based on, what Dr. Jones prescribed, blood pressure medication. You never say anything about blood pressure, so that can happen too. Okay, long-term care. Yeah, just quickly, people break down, these are two females. They had joint issues, And one woman exhausted her full benefits and died. The other one is now living at the V and in their assisted living, and she's receiving about $4,000 a month from UNIM. Next one, please, Brenda. All right, actual case studies. So the first one is a policy review. And the story on this, and I'm just checking the time here. Okay, good. We're doing all right. On policy review. So this first case, I have a friend in Los Angeles who retired about 10 years ago. And he had primarily a money management business, but he had about 150 life insurance policies. And he asked me to, take it over to service it. He said, listen, if there's any new business, you take it, and maybe in the first few years we'll do some sort of sharing. And in the end, mostly it's been a lot of service from our side. But we have worked with a number of their clients, and then some of them have bought insurance, and a few of them actually sold policies. So this was a case that I saw on the list, and it showed that there was a total of $16.4 million of insurance, and they were paying $320,000 a year. So I asked my friend Glenn, who retired, I said, what about this family? George, they're all set. They're older. These policies are guaranteed. Don't waste your time. Leave them alone. Don't bother. Don't leave them alone. I said, Glenn, what about a policy review? You were in the business for a long time. Shouldn't somebody look at this? 16 million of insurance, 320,000 a year. Maybe it's underfunded. All right, you're right. Call the attorney, Mitch in Century City. I called Mitch. Mitch said the same thing. George, policies are all set. They're never going to buy any new insurance. Don't waste your time. There's no commissions in this for you. These are guaranteed policies. Glenn did a great job. Let's leave it alone. So I said to Mitch the same thing. I said, Mitch, shouldn't somebody look at this? He said, well, the man's 85. He's got health issues. He's not going to live very long. And the female, no one in her family's ever lived past 90. She's in her early 80s, and she's doing okay, but her health isn't great. Shouldn't somebody look at it? All right, let's do a policy review. So we went and got the in-force illustrations from the insurance company, which are the projections of premiums and cash values. And what we found, my friend Glenn was an extremely conservative guy, and he wanted safe guarantees forever. Well, all three of these policies were guaranteed through the last year the carrier would offer, I think age 126 or whatever it was on the illustration. So Transamerica, and by the way, their service is an absolute nightmare. But anyway, Transamerica, we finally got the illustrations. Sure, you can continue to pay and keep coverage until age 126. But one of the illustrations that we asked for was, let's pay zero. Turned out at zero, the coverage would still go forever. It's ridiculous. So I presented this to the attorney. He said, what? I said, Mitch, you don't need to pay anything. What do you mean? You don't need to pay anything. So the Transamerica policy reduced the premiums to zero. The two protective life policies, we asked for the zero illustration, the guaranteed forever, and then what they call solve to carry coverage to age 101. What's the lowest amount of premium we could pay? What's the lowest out of pocket we could pay to carry the coverage to age 101 on a guaranteed basis? So on the one policy, we went from 130,000 a year to 27,000. On the next one, we went from 113 to 23. No one in the family's ever lived past 90. Okay, now you can always start paying premiums again if, mom is still playing bridge and playing golf at 95. You can. It's going to cost you more, but why not save 270,000 a year? So we went from 320 to 50,000 a year just by doing a policy review. 270,000 of after-tax dollars. Very wealthy family. They're very involved with the UCLA. I said, well, give it to UCLA. Give it to the grandkids. Give it to anything with 270,000 a year after tax. I wasn't paid to do insurance. After this, Mitch, the trustee, retained me, and he's paying me an annual fee to review this every single year. Next slide, please. I just told the story, so let's go to the next slide. Okay. So case number 2 is back to that theme, policy review, reviewing policies. So this was a case with an estate planning law firm They had a client who moved here from Virginia, and she had a whole life policy, very successful entrepreneur, wonderful lady, very, very bright, very engaging. And she had a policy, $2 million whole life with one of the big whole life insurance companies. And she just hadn't had it reviewed. So the law firm said, she said, I'd like to see, am I paying too much? How's this policy doing? I have over 700,000 of cash value. Hey, haven't looked at it. And the broker's back in Virginia, and he's just a one carrier person. Maybe we should look around, see if we can do any better. So anyway, it turns out she's in terrific health. And we asked her about it. She said, yes, my health is great. She really had nothing going on, health wise. We looked at possibilities, what's out there. Well, what wound up being the solution, we found with another major carrier, she could get almost $3 million of insurance by doing an exchange. So we did the underwriting. That is, we got the medical records, we had the physical exam. Turned out she qualified for the very best rates, the super preferred rate class. And in real estate, there's the 1031 exchange. In life insurance, a sister of the tax code, Douglas, is the 1035 exchange for life insurance. Don't change. Let's go back to that. Okay. Well, in any event, well, Brandon's pulling it back up. The net result is we took her from 2 million to almost 3, and we eliminated her $15,000 a year premium, and all this is guaranteed to age 105, and the policy's owned by an insurance trust. Next slide, please. The next one, and I said earlier on that, what might be available today may not be available tomorrow. What I just showed you of that case study, that might not quite be available today, but it was available then. And so that's part of our job, is to do the digging. So this one is another version of the 1035 exchange. Again, the tax code allows for taking one policy, moving it over from one carrier to the next with no taxable event. So what got these people going, they actually were founders of a public company, and they had a lot of real estate. And so what happened was they had a whole life policy with Sun Life, second to die. There were actually 4 policies, but we've kind of bundled them all into one to make the story, as simple as possible. And what got their attention was that they were hoping their plan was to pay nothing. These policies are going to fund themselves, and the dividends are going to pay the premiums. Well, what happened? Interest rates got low, and they stayed low, and the dividends weren't very good. So they started, instead of paying premiums out of pocket, they started borrowing the cash values. And I think there was a loan interest rate of 8%. Borrowing cash values, borrowing. Well, we reached a day of reckoning. And I'll just keep going. What got the client interested is that they got a bill for $229,000. So they called their estate planning attorney and said, wait a minute, we're updating our trusts, and now we have this life insurance problem where suddenly we've got this bill for $229,000, and it's about $15 million of insurance. So anyway, we were contacted. Is there anything you can do? So we went on the assumption, we'd heard the people were in great health. We went on the assumption that they were in great health. We started running some numbers, and we found that at that time, MetLife had this unbelievable exchange policy where, and the numbers are on the screen. Nothing else was close. I mean, nobody else was even close. So we went to the client and we said, this might work. We got to make sure you're in good health. They had the insurance physical exams. We got the medical records. And as it turns out, they were in great health. Once they figured this out, that once they really understood that we could take them from 229 to 0, they couldn't do it fast enough. And I'll dive into numbers here in a minute. We did have one hiccup, though, and that is that the gentleman, right before we were getting approval for the policy, went in for a hip replacement surgery. And so the underwriter calls me and says, I had been in a meeting in Texas, John, and was at a dinner with the MetLife underwriters. And she calls me. She said, wait, he's going for hip surgery today. What? So we had to wait for the hip surgery to be done and to make sure he, survived, that there's no infection. So that cost us another month or so. But anyway, again, what is available today may not be available tomorrow. So here's the math, and it's just crazy. 15 million of insurance before. Total cash value in the old policy was 4 million, but they had a $2.5 million loan. The real money, the net, if you cash the policy out, the real money was $1.5 million. That's all it was $1.5 million. So from Sun Life to MetLife, Sun Life took what they call the 1035 exchange, calling it a gross cash value of 4 million, but the net was $1.5 million of real money. MetLife got $1.5 million of real money, and they provided a $21 million of insurance with no premiums guaranteed until the female is 105 years old. This policy is not available anymore. Hasn't been available for quite a while, but they did it. And now what's happening is that every year the death benefit's going down a little bit because that's their way to, however they do their internal accounting for the interest, but they actually did it. And so this was an absolute, home run for the client because we increased the insurance and we eliminated the cost. Next slide, please. This one's real quickly a much smaller policy, but I wanted to bring it up because of long-term care. So this is a fellow, excellent health, 60 years old. He had a $500,000 policy. What are you doing? Do you need this? No, not really. I had a successful business, but his wife was disabled and receiving care. And we were able to, in this case, do an exchange for the life insurance policy to a policy that now had a long-term care rider. So in the event that he has a long-term care claim, this policy now has over $700,000 of benefits available for long-term care. And long-term care being defined as inability to perform 2 out of 6 activities of daily living or a cognitive impairment. So, and he couldn't believe it. This is too good to be true. And I had to keep, kind of proving it to him, showing to him. And once he saw, everything and saw the policy, he said, wow, how'd you do this? And it just was one of those things that happened to be available at the time. No premiums, guaranteed through his age 109. And he's got more life insurance. He's got a long-term care rider. So I want to bring this up for long-term care. Next slide, please, Brendan. Now, you see this map. The insurance folks in the room are familiar with this, and maybe some of the others of you are too. And that is, there's talk in California. I believe it's called AB 567. Is that right, guys? Anyway, there's a California bill to require that we have a long-term care policy run by the state. Now, nobody knows for sure how this is going to shake out, but we do know. Brendan, you motioning? Okay. Okay. We do know that this happened in Washington last year, the state of Washington. And what Washington did was that the state said, well, we want to, we want people to take care of long-term care. We're going to put in a state-run plan, and it's going to be against earned income. And what we're going to do is that we're going to offer an opt-out if you have a qualifying long-term care policy or a life insurance policy with a proper long-term care rider, you're exempt from the tax. And the tax in the state of Washington is 0.58%. Well, I got referred to a gentleman up there who happened to be CEO of a company making $2 million a year. If the tax is 0.58, let's call it 0.6, that would have been what, about a $12,000 a year tax? So we got him a long-term care policy. He was in his early mid-50s, about $1,000, I think it was $1,500 a year. He was thrilled. So instead of paying almost a $12,000 tax, he's paying less than $2,000 a year for a long-term care policy. The state of Washington, by the way, the benefit, the lifetime benefit in the state plan, $36,000. All right. So you're paying almost 0.6% income tax, and the maximum pool of benefit is $36,000. All right. Now, we don't know what California is going to do, but I think that many people in the industry think that California is not going to give us that runway that Washington had. By the way, Washington, what happened is that it was for the full year was the idea. If you had a policy by the end of the year, you could opt out of this. The insurance companies were overwhelmed and they stopped taking applications in September, certainly no later than October, but I think even August and September, they had just were flooded with applications. And we all have friends in the long-term care insurance business. I have a friend who this is all he does. He travels the country doing long-term care policies, and these guys were overwhelmed. They had record years. They made more in 1 year than probably they had the prior 6 years before, just by the state of Washington. And even any big company up there you can think of, somebody up there did it. So we don't know what California is going to do, but the warning is that there could be a tax that comes up. The thinking in the insurance industry is that if you get a policy that's got long-term care, you might be able to be exempt from the tax, but nobody knows for sure. Okay, next slide, please. This is an interesting case. How are we doing on time? Okay, we're good. This is another one that is an anomaly. I mean, how in the world could this happen? Anyway, so 3 brothers running a nice, successful business, and they had all bought policies, seconded eye policies from New England, and MetLife acquired New England, and they were whole life policies with a term rider. So this is the numbers up here are for the oldest brother and his wife, and they had 1.2 million of base insurance, and they had $1.5 million of term riders. So the base insurance has a guaranteed level premium. And that, in his case, the guaranteed level premium was $16,000, and the term rider at the time was $75,000 at that point. So it was $75,000 for the 1.5 million of term, and the term was going up every year, like a traditional annual renewable term. The premiums were going up every single year. So that's what concerned the clients, and that's why they talked to their advisors. What can we do? Is there anything that we can do to improve this? Are there new policies? How do we deal with this escalating cost? It's going to go up in 5 years to $173,000, in 10 years up to over $300,000 on the term rider. So we certainly, when we first saw this, thought that there's no way that the term will be convertible. They're all too old. Ages 79 through 85. There's no way this term is going to be convertible. And we started looking at other policies. We were talking to the insurance companies. We started doing medical underwriting. It turns out there's 6 people, of course, 3 couples, and 4 of the 6 were completely uninsurable. We kept asking the insurance company questions, and so finally I asked, expecting a flat out no, by any chance is this term convertible? Mr. Alexander, let us get back to you. Yes, it's convertible. Really? Yes. Okay. So we started running numbers. Ridiculous. I mean, no one does this, because back to that adverse selection, what are you getting when you've got 80-year-olds? 4 of the 6 we knew were uninsurable. Fortunately, MetLife, and maybe this is why MetLife is no longer the U.S. life insurance business. Bless their hearts, they run that other case. MetLife allowed us to convert to level premium universal life, guaranteed level premium universal life. So this is the oldest couple. So we were able to fix their premium at $65,000 a year for the term rider, which is now guaranteed level premium universal life, as opposed to this escalating runaway cost. Now, this is the oldest couple. Interesting. They're still alive. The 2 younger couples have both deceased, they're all deceased, and claims have been paid. But in any event, so again, it's one of those situations of it's available today, it may not be available tomorrow, but it again highlights the importance of policy review. I mean, who would know? Who would have asked I'm not trying to say I'm a superhero, but who would have asked, is the term convertible? A lot of people would, we don't know, we don't understand these policies, and it's gone, and we'll take the term off, it's too expensive. Well, another $1.5 million of insurance. Okay, next slide, please. Okay, I talked about the ability to sell policies. And I have two life settlement examples. I'm going to go through real cases. I'm going to go through just one of them in detail. And this fellow is a very good friend of mine and a wonderful guy, super bright. Anyway, he called me a couple of years ago and said, hey, you know, I've got $3 million of term insurance, and the policies were issued. There were actually 3 policies, but we put it all together here at the super preferred rate. I was in great health when I got them, but I've had a change in health. And I was diagnosed with prostate cancer a few years ago, but it's under control. I don't need the insurance anymore. I've got another $1 million of permanent insurance we've, saved, and I've had a nice practice, and don't really need this term insurance and would let it go. And I know about this lifetime settlement world. I've heard about it, and we'd love to get $300,000 if we could for these term policies. So we got the medical records. We started doing the underwriting, just like you do when you're getting a new life insurance policy. When you're getting a life settlement, now you're going to the buyers. And the buyers are trying to determine what is this person's life expectancy, and what they're looking for is a short life expectancy, because they're looking at the payout on these death benefits. All right. So we got medical records, and one of the things that I've really learned over the years is you've got to just you have to dig deep on these medical records. And it's a gritty, determined pace. Since scripts got hacked, I love scripts, but we very often get files, they're incomplete. And the underwriters will say to us, well, no, he's referred in for where's the Mohs surgery? It's not there. You got to go back. And sometimes the patients can help us, the clients can help us, but it can be hard, extremely hard to get medical records. But you got to do it. You can also get records through Medicare. And so it's turning over those damn rocks and really digging in to get the medical records. Anyway, for this particular fellow, we wound up really working hard for about 6 months, getting all of his medical records, and shopping with about 15 buyers, potential buyers of policies. And in the end, not 300,000, but he got over 900,000 to sell these policies, lifetime settlements. So institutional buyers bought the insurance, and he got over $900,000 to sell the policies that he might have just walked away from. Now, an important part of this is they were term insurance. The buyers, for the most part, want to buy permanent policies they can keep forever. Fortunately, these were still convertible. And by the fact that he was issued at the super preferred rate class with the term, allowed us to convert at the super preferred rate class for the permanent insurance. All right. Even though he was probably uninsurable or insurable at a very high, what they call rated premium. So the buyer looks at this and says, okay, arbitrage. This person's not supposed to live the number of years, the life expectancy that a 72-year-old who might be, 18 years or whatever that life expectancy might be. We think his life expectancy is less than 10. And it's interesting. They do life expectancy reports, and there are companies that do these reports. And then the buyers reports, but they buy reports. And those reports are different because nobody knows, how long you're going to live. I mean, what does one file on prostate cancer mean? Who knows? But they certainly know it's going to provide it should provide a shorter life expectancy. Anyway, term policies that would have cash surrender value 0, $910,000. Next slide, please. Here's one more life settlement, which I'll skip over. It was a divorced couple that, well, just quickly, they had $650 of cash value. We sold it for $835. Nobody wanted to pay premiums anymore. Next one, Brenda. Okay, Bill wanted me to talk about this one. When is a smoker not a smoker? And the insurance companies will offer, many of them will offer to cigar smokers and marijuana smokers, actually, non-smoker rates. And what they really want to see is that in the lab test that there's no nicotine. That's really what they're after. But they're willing to go with people who maybe have limited cigars Interesting though, they will sometimes, and in this case they did, accept daily marijuana use. So this fellow is in our building, a hell of a nice guy. And about 4 or 5 years ago, he asked me to review his policies. We found that one of his term policies was coming up last year. The level premiums were ending. He was going to be paying $50,000 a year and going forward. And so he said, hey, I really want to have $1 million of insurance forever. Do what you can. We get the medical records, and he told us about all this: sleep apnea, high cholesterol, former cigarette smoker, and currently daily smoker of marijuana. And he said, here are the facts. I'm just going to throw it all out there. But my mother, and so I think I have a chance to live a long time. So we did what I talked about earlier, which is the informal underwriting. We got the medical records. We had the physical exam. And most of the carriers came back, their underwriters came back and said, hey, look, you know, all these factors, we see him as rated, meaning that if you are standard, that's the sort of the baseline pricing. Rated in his case would be about 2 times the standard rate. And then we had a couple offers that were standard smoker, because they said, hey, look, you know, the guy smokes marijuana every day. We want to charge him smoker rates. But one insurance company said, we see him as a non-smoker standard. As a matter of fact, last quarter of the year-end push for business, they wanted their numbers. For anyone who buys this particular type of permanent policy, which is actually not a bad policy, we'll upgrade them from standard to preferred. So in the end, this fellow got a $1 million lifetime policy at a preferred non-smoker rate, and $21,000 a year for $1 million for lifetime, 2%. That's not bad. Not bad. Okay, next slide, please. Okay, in-force premium financing. So this will be probably my last case study. There's 2 parts to this. So and the second part is what really had the client, the reason he was motivated to talk to us. But this is a kind of an anomaly. In 1986, this fellow, actually he was I list him as an executive. He was really a professor at a university, prestigious university back east. Anyway, so his CPA called me and said, hey, I have a client and he's really concerned about his policy. He's got this single premium endowment. There's a large loan and looks like we got a big tax liability possibly looming. What can you do? Well, this is part A of it. So what happened was he bought a single premium endowment policy back in 1986. So it really wasn't, it was life insurance because it was technically a life insurance policy. It was really an investment. It was more like an annuity. It was a single premium. He put $400,000. And back in those days, I'm not sure what the interest rate was, but he was probably getting 6 or 7 or 8%. John's nodding his head, probably that, something like that. And no more premiums. And that was guaranteed. I'll just one quick thing, which deals with the next slide. With the single premium endowment that was issued by this particular insurance company, when he turns age 95, it would endow, meaning that they would pay everything out to him at age 95, which is a very important part of the story on the next slide. But anyway, as part of this, I saw he had this $3.2 million loan and it's 8%. So we started talking to the companies, the banks that loan money. This happened to be Wintrust, John. And we asked, hey, well, what could you do? Well, this was a few years back, and Wintrust was willing. They weren't very comfortable with the policy because it's hard to get in-force illustrations, and the policy, looked like a handwritten illustration because it's so old. But anyway, in the end, they took over the loan. So what they did, the premium finance company said, here's what we'll do. We will pay off the policy loan, $3.2 million, and we're going to charge you, let's call it 3%. It was actually a little less than 3. So now the loan interest is 3% instead of 8. 5% is the savings on, all that money, it's 160,000 a year savings. All right. Now, the other part about it, the reason why the loan got so big is that the client was only paying $5,000 a year. So the loan was accruing and getting bigger and bigger and bigger, and 8%. I see Paul Hines nodding his head, compound interest, 8% keeps going and growing and growing and growing. So in any event, this is a loan that renews every year. And last year we renewed it at a little over 5%, but which is still a pretty darn good rate. But the point being, we're saving a lot of money in interest. Now, another byproduct, which we didn't know would happen, the policy itself is doing better, because if if there's no loan, actually the performance of the policy were better and the crediting was better. Now, outside collateral, at the beginning, there was a little requirement. I think there was about $60,000 or $70,000 of outside collateral. After the first year, Wintrust waived the outside collateral requirement. So really, Wintrust is basically collateralizing its own money. This guy has, let's just say no cash. They put in the 3.2 million. And what they do is that on the loan documents, they're entitled to the death benefit to the interest of their loan as it appears. The cash value is to the interest of their loan as it appears. He can't take new policy loans. So they're protected like you would with a piece of real estate. It's collateralized. But what a wonderful deal for the client. All right, next slide. Now, this is what was keeping him up at night, and the reason why he contacted his CPA and attorney, actually, because he was looking for solutions. The problem with this situation, his birthday present, if he happens to live to age 95, would be a $7 million 1099. Okay, because this loan was growing and growing and growing. And remember, endowment contract, it's going to be paid out at age 95. No turning back. Here's a check for about 100,000 of net cash value, net alone. And here's your 1099 for $7 million. By the way, because it's life insurance, it's ordinary income, not a long-term capital gain. So it's a little extra kick. So this was keeping the guy up at night. He has longevity in his family. He was concerned. My God, I live to 95. I'm going to get hit with this $7 million 1099. What can we do? I showed you that prior slide where we had a carryover of a loan on an exchange to a new policy. Couldn't do it. Not too many options available. He's fundamentally in good health, but there were, one or two things that the insurance companies didn't like. So we had no exchange options. So very smart guy. And he says, you know what, George? I think we should talk to the insurance company. What do you have in mind? I have the name of the CEO. Really? I have all of her contact information. You do. Let's start contacting the CEO. We contacted the CEO, and she was incredibly responsive. Within less than 2 days, she sent back an email saying, thank you for contacting us on behalf of your client. And this is interesting. I want you to talk to Lieutenant, a VP. I called him the next day, and he was incredibly nice and engaging. And he said, we're starting to look at this. We know we have some policy, but it hasn't really hit the radar yet. So the client, this is killing him. I don't want, I want to live to 95 and celebrate it. He says, well, let's send him a letter and let's demand that they, do something. And so what does do something mean? If you endow, you're going to pay ordinary income tax. If you die, they deduct the loan from the gross death benefit, which is a little bit higher, and they pay out a little bit of money, maybe $100,000, and that's a tax-free death benefit. Okay, so we're going from 7 million taxable to maybe 100,000 tax-free. All right. So we did some more research. and actually client paid me a favor to do this. We did some more research and we found that other companies have made changes to enforce policies. They offer what they call extended maturity. It wasn't uncommon in the 80s or before for policies to be done at age 95, because who lived that long? I mean, there were a few grandmas out there, but not that many. So we found that Equitable and a couple other companies had offered extended maturity. So we started citing these examples and sending them to the carrier. So the first letter we sent, they basically told us to go to hell. Contract's a contract. Sorry, Mr. Alexander, your client bought a contract. Contract's a contract. Anyway, but after time, we persevered. And then finally, after 2 years of letters, calls, screaming, going back to the CEO, crying, this is unfair. Finally, the lieutenant got back to me and said, well, we have some good news for your client. We are now going to offer for anybody 6 months before they turn age 95, we're going to offer extended maturity. In other words, we're going to take this policy out to age 115. So as long as your client is cooperates and dies by the age of 115, we will pay this out as a tax-free death benefit. So that happened for him and, you know, all the other people who are in that class of policies. Again, what may be available today may not be available tomorrow, but it came about as a policy review and persevering and digging in and doing the work. Have a very smart client as part of the process and having a lot of good ideas. And outside the box situation. Okay, next slide, please, Brandon. This is it. Yeah, I'm not going to do this 10:35. I'll closing remarks right now. Skip this one, please. Last couple people getting declined for insurance. 1 minute on this slide. It just basically, if clients aren't honest and they don't tell you up front what the facts are, they're going to have a hard time getting insurance. This guy didn't tell us about atrial fibrillation procedures he had at Stanford. He got declined. No, it was brutal. Another guy had a Ferrari, didn't tell us about his suspended driver's license, driving over 100 miles an hour many times. He couldn't get insurance. Okay, last slide. Okay, so kind of wrapping it up, you know, recurring theme, closing with this, informal inquiries. We're getting medical records and we're having exams and we're working with the insurance companies to try to get the best possible rate for the client. Also, when they're looking to sell a policy, we have to do the same thing. So it's digging in and doing the work and really, and I think what Bill wanted me to leave all of you with, and that's add this to your list, advisors. One question to your clients next time you meet with them for an annual review: when was the last time you reviewed your life insurance?
George, that was really spectacular. Thanks so much for your ability to get through those case studies, because I think that really showed everybody the amount of work it takes. When you work on complicated life insurance cases with complicated fact patterns, it really takes a lot of time and effort to work through these. And you can see the creative solutions that someone who knows what they're doing in the industry and has experience, decades of experience, can get these things done. And they know who to call and they know what needs to be done to help the client, regardless of whether or not he's actually getting paid, selling a new policy or not. He's doing the right thing. So George, can't tell you how meaningful that was. Really learned a lot. Hope everybody enjoyed that presentation. Feel free to give George a call, reach out to him via email with any questions. We look forward to seeing everybody on September 5th. Thanks again for being here. Have a great rest of the week. Thank you.